If the tech bubble bursts, Vanguard Value Index might be the place to hide. Oh, right up my alley, because I've been an advocate for a Vanguard Value Index for many, many moons as my largest holding. So my man Scotty B sent this to me. So let's check it out. Scotty B, no kin to Cardi B. Cardi B. I don't listen to that crap. I just think it's funny. What's up, dog? Come on, come on up. All right, this is Paul Frank, or Frankie, from Seeking Alpha. If Tech Bubble 2.0 is bursting, Vanguard Value may be a great place to hide. The individual names owned by Vanguard Value ETF were a great place to hold money during the tech bust of 2000 to 2002. Valuation for equities and VTV are in a different universe than high-flying QQ. What's up there, Grumpy Skin? The high-flying Qs, ETF stocks. If 2021 is the year for the tech bubble to burst, owning Vanguard Value will be a better idea than holding QQQ or the S&P 500. What's this guy right here? It just cracks me up, this little guy. Not this little guy, my big baby over there. We've all been anxious for years, waiting for the FANG stock to run to end, or at least slow down. Article after article has called for an overdue switch in investment themes to return from growth to value. The rotation of capital is how Wall Street works. However, all the logic in the world has not stopped the steamrolling gains by big tech. Today, Wednesday, the 27th of January, we experienced the largest percentage drop in 3 months for the U.S. market, and the decline wiped out nearly a month of gains for the major indices. Going to February 2021, what if the train wreck for technology names has arrived? If a tech bust is beginning, where should investors hide wealth and still have a chance of earning a decent positive return? It seems like the markets are way up today, like 600 points on the Dow, something like that. I'm not sure what's the driving, who's leading it, who's leading the tech revolution. But hey, this guy needs to go outside. Hold on just a second. One answer may be simple to execute, has real precedent considered from the original tech bubble peak in 2000. I suggest investors consider buying the blue chip tech alternative based on low PEs and high dividends, the Vanguard Value ETF, VTV, which is the antithesis of the NASDAQ 100, QQQ. Hold on. Cost Trust Index with an expense ratio of 4 basis points is chock full of consumer defensive, major bank, healthcare, communications, industrial, energy, basic material, real estate, utility, and cyclical companies. Only 7% of its holdings are labeled as tech picks. 327 stocks and a small cash position were reported at year's end. Financials represent the biggest, with healthcare number 2, industrials, consumer defensive. Does that mean consumer defense? Like, Lockheed Martin? I don't know. Below is the list of the 10 top holdings by weighting at the end of December. All right, all appear to be worthy of investment today. Berkshire Hathaway, Johnson & Johnson, don't they get a vaccine? United Health, Disney, Verizon, Comcast, Bank of America, all the companies that I just, they're all woke. Valuation differences between VTV and the Qs. I thought they got rid of the Qs. I thought it was not 4 Qs. 4Q, 4Q. There's a old song by Blitz, an old British oi, then became a kind of like a moderate punk band, and it was called 4Q. Actually, pretty good song. On the album Voice of a Generation, pretty good album. I think an understanding of the huge divergence in underlying business pricing between traditional value names and the high-flying tech stocks would bring home my argument. Below is comparison of forward PE ratios for the top 10 holdings in Vanguard Value versus the NASDAQ 100. All right, so the NASDAQ 100 currently includes Apple, Microsoft, Amazon, Tesla, Facebook, Alphabet, Google, NVIDIA, PayPal, Adobe, and Salesforce. All right, so we're looking at the, what's this? Johnson, is that Johnson? Johnson, 33? Wow. All right, so we got, all right, so basically 21, 33, 19, 17, 10.5 is Bank of America, it looks like. And then we go to this guy. Whoa, 121 is Tesla. No, Tesla doesn't even have 121. I don't know what. Tesla doesn't have a forward PE of 121. Do they? I don't know what. Okay, that's pretty. I don't. That doesn't make any sense. That means they think their earnings will go through the roof. This was the problem with forward price to earnings ratios, projections based on what they project earnings to be. If you would have had forward PE ratio in 2020, the start of 2020, you would have got smoked because the earnings dropped like a brick in water because of the stupid reaction to COVID. But anyway, pretty significant difference here. I mean, their lowest is 2069, which is Facebook. Yeah, see, I don't. No way, man. And then the lowest here is half that. Even more striking is the forward price to sales curve. VTV is priced at 2.7 times sales, while the Qs are 8 times Wall Street estimates for 2021. Sure, you can argue with higher growth is worth a higher multiple, but do you think the largest companies by market cap in the world will continue to grow at a 3 times rate as the rest of the economy? That's a gamble you're taking when you purchase the Qs. I even say the value growth, not the value growth, the Vanguard growth ETF as well. So there's a price of sales. This pink one is United Healthcare, basically $1 for every dollar sales. Man, that's crazy. A final comparison is I don't like that forward stuff. I mean, I get it. You have to start someplace. The problem is just if something happens. I mean, we don't know. But a final comparison is the VTV dividend yield of 2.5 on trailing payouts. So forward-looking PE, trailing payouts on dividends. QQQ pays a minor 1.5% dividend yield, roughly a fifth of the cash distribution of the blue chip value choices. If you are a total return or income-focused investor, at some point the technology leaders are not worth the price of admission. I agree with that 100%. Here's my investment argument in a nutshell. When the tide turns against technology and the price bust hits, only blue chip stocks outside the NASDAQ will be a home run. I don't know it'll be a home run, but it'll certainly keep you on the base as opposed to striking out with the bases loaded. Let's look at the tech bubble in 2000, 2002. I've drawn the total return performance, including dividends, of the top 10 holdings of VTV during the seminal technology bear market of 2 decades ago. Vanguard value was not created until 2004. Using equal weighting of the 10 equities, the mean average return was a gain of 12%, a median average loss of 15%. The small gain or small average loss ran circles around the complete wipeout of the overextended Qs for 36 months, 100%. The NASDAQ 100 product and the regular S&P 500, which includes the largest tech favorites, have outperformed the lower growth, lower volatility picks in the Vanguard value over the past year. However, times have been quietly changing. Over the last 3 months, like I've been saying, Vanguard value is generating the same performance as those other two in a world where there is, Finney, stop it. Jeez Louise and blue cheese. You eat my slides. No. Let's see. In a world where reversion to the mean and the rotation of capital tend to equalize returns to the market, perhaps an investor would expect the VTV to outperform many other index designs for a spell. Yeah, we'll see. All right, good stuff. Who knows what's going to happen? What's he doing now? Oh, no! Oh, boy. I love that dub. He's not. I think that makes sense, 100%. I mean, who knows what's going to happen? But at the end of the day, we know the S&P 500, the large cap growth, the Qs are heavy into tech, and tech has had a run like freaking we haven't. You can't deny that. Hard to imagine it continues on the way it has been. Just hard to imagine. As such, might not be a bad idea to take some gains, diversify for sure. But remember, I do own VTV. It's my largest holding by far. So, because that's my largest holding, you might want to go hedge fund like and short it because if I own it, it's a sucker's bet. All right, we'll see you guys.